Hey everybody, happy Friday, end of the week, end of the first week of the global financial meltdown, still underway in its fifth day, despite the little bounce in the markets. Now, important to understand, my good friend here, Edward Milewski, who is going to be investigating, analyzing, pontificating, surmising, deducing.
All those ings.
You'll be inging it up over here. And we're going to talk about some of what's been going on at the hands of the governments in various countries today and how it affects us as the people. The people. We are the people.
Peoples.
I'm one of the people. I'm a man of the people.
Or if you have two people, is it peoples?
No. No, sir, it is not. People,
well, they always talk about the peoples and the notwithstanding clause.
Nobody calls them the peoples, no mo. Who are the peoples?
If you follow people, then you're a sheeple.
And what happens if you follow sheep? You're a poople. Hey, good news. The government of Canada just announced $10 billion in financing small loans for small businesses. Check out Ottawa's BDC to find out more. Hey, was that a plug for the government? No, it's a way for you to get a handle of that $10 billion.
Get some of that filthy lucre.
That filthy lucre. We're gonna take a stab at getting a half $500,000 loan, just because it's near interest free, and we're going to use it to grow the business that we've lost thanks to the coronavirus, because we've lost a lot of business.
Interestingly enough, the 30-year rate and the 10-year rate are both quite a bit higher than they were last week. So the interest rates have gone up after that initial plunge.
Yes.
You know, like for instance, the 30-year rate got down to 0.8%.
0.8?
It's now about 1.5.
Huh?
And the 10-year rate, which got down to 0.4, is 0.9 something now.
So what does all this mean? What does it mean?
Maybe they went down too far. Rates are still very, very low.
Yes.
But if you're betting on rates going lower, you got a little poop on your face right now.
Bank of Canada just dropped the overnight rate to 0.75% from 1.25, 50 basis points. That's quite something.
Well,
that's not nothing.
You got to think Canada is sitting in a pretty precarious position. I mean, relative to...
Well, yeah. I mean, look at our oil revenue has now been decimated. Certainly our ability to process refined petroleum products has been decimated by the, by the difficulty with which pipelines and transportation infrastructure can be developed. Mind you, I'd rather be a shareholder in a Canadian oil company than I would be in Saudi Aramco.
Really?
Well, wouldn't you? So
Saudi Aramco is still capped at a 1.6 trillion, I think.
Right. So down only 450 billion from their IPO of what, 3 months ago, year ago.
Yeah.
So Saudi Aramco takes all this money from all these large-scale capital participants.
Well, a lot of the money came in from the inside, apparently, like from the inside.
Oh, I'm sure.
Yeah, because a lot of the outside people said, "Hey, the valuation's nuts."
It's insane. And now we're going to start a price war. Now we're going to cut the price of our only commodity in half.
Yeah.
Just to flex our Saudi Arabian muscles a bit. That doesn't strike me as very good. I saw a real idiotic piece by a CBC writer today that said that travel bans don't work, experts say. Travel bans don't work, experts say. Now, I took exception with that basic premise because how could a travel ban not work? If you have zero contact with the infectious source of a virus, then how can a travel ban not work? Secondarily, I took real exception and almost burst into laughter because the article concludes with the admonishment to, if you're sick, stay home. Is that not a self-imposed travel ban? So which is it, CBC? The travel ban doesn't work, or the travel ban is the only way to avoid spreading the virus? Hello? It's not that it's fake news, it's just bad news.
So what happens to that? Let's say, yeah, you got the virus.
You got the virus in a box.
And then you stop, you stop. If you have the virus, does the virus go away by itself eventually after it kills you?
After it kills you?
Well, no, but so it moves from me to you. But if we don't make contact, it can't move from me to you. What happens?
Oh, well, I think it just has its way with you until you've got nothing more to offer it, or
but viruses are parasitic, right? They need a live host.
I would say opportunistic more so than parasitic.
Well, they can't. If you die, they can't live.
If you die, you dead. That's true. If you die, they can't live. Well, so if we all died, there'd be no coronavirus.
There'd be bacteria.
Maybe bacteria.
Maybe we'd have a show here with some coronavirus hosting.
Geez, I wonder if we could get a bacteria on the show. A bacteria and a coronavirus walk into the bar, and the coronavirus says to the bacteria, "Hey, did you see that latest Purell?" Oh my God, we're really desperately grasping at straws here. Yeah. Okay, so people might say today, well, James and Ed, you're a little bit pessimistic because the market's up a little today.
Yeah.
And to which we would retort that if you're going to focus on the bobbing cork, you're going to miss the rising and lowering tide, meaning that the big moves don't happen in a single day, although this week they certainly did. But the bigger move is happening over the course of weeks here, and like $4.5 trillion. Now wrap your head around that. They took that $4.5 trillion in financial stimulus that they have now launched across all of the Fed programs, and they divided that up among 320 million American men, women, and children. How much would they get each? $14,000. $14,000 bucks
that's
each.
not the way it's going to work, is it?
Well, I say we create let's start a petition. And so let's say that once a month, they create $4.5 trillion in money out of thin air. And instead of, giving it to the bankers over here and the companies over there, why not just give each man, woman, and child 14 grand a month? Then everybody'd be rich. Then the economy would be on fire because everybody would be spend like a drunken sailor. And it would be on fire. Would you not agree with that?
Well, Trump, sure. I mean,
so what is the difference between taking $4.5 trillion and giving it to a bunch of bankers and taking $4.5 trillion and giving it to the people?
Trump said something today that I thought was interesting. He said the fastest way to give this thing on, to get money in the hands of people is to don't deduct any income tax for the next 60 days. So no matter what you get paid the full amount.
Yes.
Sounds like a pretty good idea.
Well, not bad.
Since I'm,
I thought that was interesting, but how do the people on Social Security get paid?
Double up Social Security?
Well, no. I mean, how do they get paid normally? They get paid through tax revenue, right? And all of the federal government employees get paid through tax revenue. So where does that tax revenue come from?
Well, they just create more deficit. That's all they're doing here.
Right.
Like the deficit's never gotten, in the last 20 years, has there been a year or two where that's gone the other way? No, I don't think so.
Tax has gone down?
Or revenue, like let's say.
Tax revenue.
Deficits are always increasing. It seems like we never really.
Oh, the deficits don't go down. No, that's for sure.
So where does that money go? Well, the rich get richer.
We don't get any. Well, mind you, the Canadian government just announced $10 billion in funds for small businesses affected by the coronavirus. We've been decimated by the coronavirus. We haven't been able to talk about anything. It's turned us into right proper idiots who have nothing but one thing in mind: the collapsing stock market and the coronavirus going up our nose. What is wrong with us? Do you notice? Look on the street. See how barren it is?
You know what? It's like Sunday afternoon.
It's really quite pleasant, actually.
Yeah.
I wish there was a coronavirus around all the time.
It's like there's a blizzard out there, but there's no blizzard.
Right. It's like everybody watched the news, was told to stay home, so they did, except the people who knew that, that's just alarmist bullshit. Let's go to work anyways. But yeah, quite funny. Quite funny, people bumping arms and thinking that they're somehow alleviating the risk of getting infected. Yeah, tap,
A
tap.
new dance.
Yeah.
A new dance on the dance floor.
Coronavirus chicken dance.
The other thing that's
hands.
interesting is that gold this week, from the big surge it had after, there was something that happened earlier in the week. It's down $200 basically.
Okay.
And I just don't. I'm not sure many people that are
Somehow alleviating the risk.
pro gold would have saw that. I certainly didn't see a $200 drop. I thought it would stay, maybe around 1,600. It's close to 1,500.
Really?
15.
15. That was an excellent year, by the way.
Is there an echo in here?
That sounds like there might be. Okay, so gold is taking it on the chin. But if we look back to 2008, 2009, what happened with gold then relative to what happened in the stock market?
Well, gold dropped and dropped and dropped, but it caught a bid apparently around September of 2008, which was the bottom for gold, September 2008, September, October.
Yes.
And the market didn't bottom until March of 2009.
Right.
Okay, so there was a bit of a lag there, but gold started moving first.
Yeah.
So let's see what happens.
Well, so that's just it. And then gold went on from, what was the level that it was bottomed at in 2008 during the financial crisis?
Gold?
Yeah.
Well, let me tell you.
Yeah, please do.
Gold, okay, and this is okay, I can do that. So here we go. It bottomed around $675 in September of 08. Yeah, that's what it says. I'm not making it up.
September 2011, it topped out at $1,920, correct?
Yeah.
And at its trough, during the financial crisis, it touched a low in August 2008 of $872. No, it got down to $600, as I recall. Isn't that correct?
When did it get down to 600?
August of, or rather,
08?
08.
So it got down to about look, according to this.
October of 08.
Yeah, October of 08, it looks like it got down to about 675. According to this chart. And you can, okay, that would be this part right here. There we go.
Any second?
And click.
Come on
and
up there, a little chart.
And that's that number there. I think that's around 675. But remember,
675. Okay.
Look at it. Look at this move. Look at this. That was the move. Now we've come down here. We've got this. Yeah, is this like a top here versus that? If that's a top, which it looks like because we're down 200, we're back down to yeah.
Well, or is this the?
Or is that the French? Is that the
row your boat?
Latin word for gold?
Or hey, very good. It's Spanish. Oro. Anyways, so in 2008, gold at 675, and then in September 2011, 1920. So basically, the price of gold tripled, and then some. So if the price of gold is going to triple from the low off of this financial crisis, what price does that give us, Edward?
Well, if it got down to, say, it's 1,500 now, so triple that's 4,500. But what if it gets down to 1,400? Then it's 4,200. In any event, it's a big number.
Yeah, and in any event, no matter what happens, the price of gold, should it respond in the same way it did at the end of the 2008, or at the end of the drop at its low after that, then it's got a 3x in it from here in less than 2 years.
Even a 2x would be mind-boggling.
Well, a 3x would be a buy. Could you imagine 300% increase? Anyway, that's one of the opportunities that is actually the outcome of the negative development of the financial crisis now unfolding all around our ears. Secondly, so here's the thing. We're backing off a bit from the idea that the world is ending here because the government's thrown $4.5 trillion at the problem.
That's mind-boggling. $4.5 trillion.
In a single operation.
If that means that they've doubled, like the money, like we were talking about, what, $500 billion in 2008, 700 billion or something like that.
Yeah.
And now we're up to 4. So does that mean there's like 8 trillion out there now?
Well, theoretically, let's see. So What's the plan here? The 10-year more than doubled from 0.38 at the low on Monday to 0.88 at the high point yesterday, correct?
Yep.
And the 10-year yield spikes during a stock market crash. The fact that the 10-year yield spikes during a stock market crash is a scary thought, according to Wolf Richter. Yes?
Yes.
So Monday morning, the Fed raises the maximum of the overnight repo from 100 billion to 150 billion. Again, I'm reading off of Wolf's site because he has a great job of...
He's on it.
Tuesday morning, it raised the maximum for the twice weekly 14-day term repo from 20 billion to 45 billion. So that's incredible. Then Thursday morning, the Fed then raised the maximum overnight repo rate again, this time from 150 billion to 175 billion, and added $50 billion to a 25-day repo to the mix. Then Thursday early afternoon, in a surprise shock and awe move, as I just realized that's where I got that comment, the Fed announced it's going to offer a series of $500 billion term repos, at least through April 13th, amounting to $4 trillion in new money over the 4-week period. So that's $4.5 trillion but this is interesting. So wait a sec here. So what happens with does that go on the Fed's balance sheet if it's in the repo market on an overnight basis?
You're asking the wrong guy.
Well, so this is the interesting thing. They're trying to hyper-stimulate the economy by keeping it off the balance sheet. Anyways, but the bottom line is that if this is the approach, is that, and I do believe we mentioned this in our coverage earlier, it's that, well, I mean, there is a possibility that the Fed will try to exponentially increase the volumetric approach to quantitative easing at the market in response to this. And we did say multiple times over the last 10 years that, never mind billions, the next round of stimulus is going to be measured in trillions. And here we are, yet again, proven right by the Fed. Yeah. So the question for me is, if the Fed is going to keep on, amping up the amount of $1 trillion bailout
Amping
package,
or ramping?
Ramping, more or less the same in a metaphorical sense.
Okay.
Then at some point, they're just going to have to start buying assets directly out of markets, and the market is going to come back. I think this coincides with Saudi Arabia and Russia solving their differences, the coronavirus running its course for the current flu season, and then it's going to be game on like it hasn't been. Like, that's going to make...
and we got to watch... with all this money out there, we got to keep our eye on commodity prices. Like, for instance, we saw the shit get kicked out of platinum here, or palladium. Yeah. Palladium's been, what's it down, a third?
Palladium has lost a third of its value. It's below 1,800 now.
Yeah, it got to 26. Okay.
Silver's down to 1,400.
14 and change, yeah, and that was about $18.
Yeah.
I mean, but they keep printing. They keep printing. That's the one thing that seems to be, and yet interest rates have moved up a little bit.
Yeah.
Oh, jeepers.
Okay, well, let's take a quick look at the cannabis space here, because it is getting extra treatment, and we're going to talk to Alan Brochstein from 420 Invest on that. Oh, yeah, he'll be coming up shortly, and Bruce Campbell from Stonecastle Investment Management will be here. We're going to touch on cannabis, but mostly we're going to talk about the other opportunities. Lance Ippolito from the Future of Wealth will be here, but right now, here's Alan Brochstein. I'm joined now by Alan Brochstein, publisher of 420 Invest. Alan, welcome back.
Hey, how's it going, James?
Well, I would say that I've seen greener pastures, but it is what it is the other cliche that I've got to resort to here. What are you seeing in the cannabis space in this historical days of market rout?
Yeah, well, we're definitely taking a backseat to the overall market conditions. And, we've been talking about this for a while, James, regarding the challenges for the industry in terms of capital availability. It kind of really got exacerbated. I mean, it was a problem anyway, but it was exacerbated when the vaping crisis. So these crises just come, they just keep layering on. But when that thing hit in the fall, it really hurt the ability of these companies to raise capital. And so in October, I shared with my subscribers kind of a one by one on the names I follow closely, kind of where they're positioned in terms of risk with respect to raising capital, and then I had to update it. I think it was just this last month in February. So we're definitely, unfortunately, we're seeing yet another huge problem, right? Because when the whole world is burning down, nobody cares about the cannabis sector. And so this week's been especially telling. We saw Harvest blow out their stock price by announcing a partially done deal at a significant discount to its prior low. And then we saw today Tilray, and this is unbelievable to me. I mean, I've been negative on Tilray and worried about their statements that they had enough cash to make it through this year. That doesn't seem plausible until today. But so if you didn't see the exact pricing, and to put it in perspective, it was a $17 IPO, and then it obviously went to $300. They had done a private placement at $7.10 in just 2 years ago, ahead of going public. And now one has to wonder if ever that stock can get up there. Ever is a long time, of course, but hopefully they have their capital in hand now, so that enough to bridge kind of their shortfalls. But this is incredibly dilutive. We've gone from a very tight float stock, if you recall, that being almost entirely controlled by formerly privateer, to now one where there's a whole bunch of shares that just hit the market and a lot of warrants not far behind.
So I guess this is sort of part and parcel of a general market revaluation, discount to the downside based on a collapse in investor confidence. What are the stronger companies that you think, in an effort to look on the bright side, where are the companies that you are not worried about, that you think will be able to weather a storm by virtue of a solid cash position and essentially a stable business?
Sure. In Canada, I've had a really hard time really understanding the potential of Kronos Group, following it since its early days when it was PharmaCann. But I have to say, the worse things get, the better that company seemingly would look. I have never advocated buying it, but it's trading very close to its cash value now, and there's no debt. There's a few liabilities. With that said, brace yourself for a really bad quarter that's going to be announced God knows when. It was supposed to be, they're late, and they could remain late. So industry, nothing ever goes smoothly. But that's one in Canada that I think people should be aware of. In answering your question, it seems very unlikely that they'll have a cash situation. And I would say as well, adding to that, two others that have done capital raises and that, in the past have generated earnings or positive cash flow are the extraction LPs, Valens and Metapharm Labs. So those two would seemingly be at a lower risk than many others that, especially in Canada where the operational cash use is just off the charts still. So, trying to find companies that don't have debt and that have relatively large cash balances and or small cash burns. Those are the three that pop up in my mind. In the United States, a little more tentative. Things have always been a little bit harder for these companies to raise capital. They didn't have the luxury of it being thrown at them the way it was in Canada. And so now what we're seeing is, all the big four, as I like to call them, which would be Cresco, Curaleaf, GTI, and Trulieve, all of them have made new all-time lows. They've all been the same strategy lately, which is we're not going to sell our stock down here. We're going to raise debt capital. Maybe we'll issue a few warrants. That's been a while since they've issued those warrants. And obviously an even bigger phenomenon has been the sale leaseback. So these guys have been able to access capital, but it's not free. They're going to pay higher costs because they're renters now. And on top of that, if things stay really bad, they don't have an asset that they can sell. They're doing that now. But things are kind of challenging. So I think there's, it's really interesting because I think all four of these companies should emerge, and they're going to face a lot less competition if market conditions remain unfavorable. And I would, to just call out among those four, obviously, you take a look at TrueLeave, and they have positive cash flow and positive earnings. But there is some debt there. And then I would also call out Liberty Health. The stock's bounced off of its bottom. It pretty much doubled, but it's pulled back close to those prior lows. It's been outperforming the market, but that's a good fundamental story, or has been a good fundamental story. They sold some assets. They have cash on their books now, a little bit of debt, but more cash than debt, and they'll take care of that debt. And they're very focused on just a single state. It's not a complex story, and they have generated positive cash flow, I think, for 2 straight quarters now. So that's another one that seems, at the cusp of success.
Sure. Do you think that the coronavirus crisis, in that it is a respiratory affliction and a lot of the cannabis products are ingested through the services of the lungs, do you think that the crisis is actually going to have a direct impact negatively on sales of cannabis products around the United States and Canada?
No, I don't think so, really. It's, the numbers are pretty small, James, in terms of, it could get worse, so I want to be careful about that, but hopefully, all the steps that are being taken in cities across the nation, and I just saw President Trump declared a national emergency moments ago. Hopefully this will keep it from becoming like Italy, and even if we become like Italy, it's temporary, right? So I don't think it's going to be a huge issue. As a matter of fact, there's been some evidence that people are worried about access. Gosh, I don't know what it's like in other places, but here in Houston, the grocery store, all the frozen goods and canned goods are being bought in mass, and so the same thing's going on apparently to a lesser degree, though, with cannabis. So there may be actually a short-term lift, but I don't think that's the part that's worrisome. What's worrisome is the impact on the ability to raise capital. Remember, there's already a huge capital crunch going on. Even before this financial crisis just developed, this was already a problem. So that's the main impact of the coronavirus. It's not necessarily a top line issue. It's a financial issue.
Mm-hmm. Okay, so then what's your counsel to individual investors as it pertains to cannabis stocks at this point?
I'll pull a Will Rogers. Don't buy them a few months ago. No, unfortunately, you have to live with your prior decisions. And one of the things I try to warn people about all the time is this is a very volatile sector, and a lot of unproven companies, obviously. Even like the one with the highest market cap, Canopy, is unproven. Let's just agree on that, I think. And so what I try to counsel people is just don't put all your money into the sector. It's really bad portfolio management. And I hate to discourage people because maybe things will triple like they did a year ago off the December 2018 lows, triple in some names, I should say, not the whole market. So I don't want to talk anybody out of big gains, but just seems like we're fighting a lot of battles. And James, what I've told people is at the beginning of the year, I said, I don't think the first part of this year is going to be great because we have people that are underwater on their stock that will sell into rallies. We have companies that need to raise capital. We have founders and early investors sell into strength. So that whole confluence of sellers, I thought needed to be cleared. I have to confess, I did not envision this kind of market. I don't know who did. I'm sure somebody did, but it's been obviously a lot worse than I would have expected. But I still think the news flow should get better later this year, but we really need this financial crisis to be behind us, I think, before one can be really confident in investing in our space any more than they're already invested.
You bet, Alan. Well, great contribution as usual. Thanks very much for joining us today. We'll come back to you soon.
All right, take care, James.
Oh,
the
that
saddle.
nick of time, not nicotine.
I'm going
nick
to
of
change your
time.
name to Nick West because you're in the nick of time.
In the nick of time. Anyways, yeah, so I guess Alan Brochstein's cautiously optimistic that the recovery will come for those cannabis stocks that have cash and a functioning business.
James, can we look at China and apparently a lot of stores are reopening now in China because I guess
the coronavirus has been and gone.
I that's what I'm hearing. Okay. I don't know if that's true.
Well, tell you what, let's take a look at South China Morning Post, scmp.com. It's a Hong Kong-based newspaper that is only somewhat railroaded by the Communist Party. There's usually some good information there. Let's see. China, US. Well, I don't know. I don't really see too much indication that the stores are reopening. Mind you, this...
Well, they talked about some of the Apple stores coming back. I mean, look, if that's true, then we can sort of look at the times involved, like from what...
Yeah.
And say...
Well, so they have tracked the first coronavirus case back to November 17th in China.
So November 17th, and so things seem to be getting better in China, and we're got 4 or 5 months.
Right. Well, but that's so basically China's epidemic began in mid-November when the height of flu season would be in the middle of that period, which is now in retreat. So arguably, in the case of Canada, we're still under 200 cases in Canada, and much bigger geography, seasonally
well,
warm.
not that, China's a big country. It looks smaller because it's got all these other countries around it, but it's still a pretty big country.
Mm-hmm. Yeah, it's not bad. Isn't it number 3, number 4, number 5?
Number 4 from...
Okay, but yeah, there's, I don't know. Doesn't seem that there's a lot going on in the...
Italy looks like it's shut down like tighter than a drum.
Yeah, well, it's just announced its single-day record with 250 new coronavirus deaths today, which it's the end of the day there. 250 deaths in a single day. That's frightening, because you look around and say, well, who among us is going to be a victim of this thing?
Yeah.
But as we were saying earlier, I bet you the rate of infection and death is probably much higher in the higher risk demographic of over 60. But, you can never be sure of that. What else we got to look at today? So today, the marketplace is basically showing a bounce. What's the S&P telling us today, Ed?
The S&P, well, I'm going to put it up right now here. Here we go. Here we go. S&P, well, it sold off here. It looks like it's 25.48. The high for the day, 25.73. The low, 25.4. No, that's not right. That's not right. What am I looking at? Selling off here. The high was, why is this not showing? I can't give you the information you want, but it's selling off sharply as we speak. The high for the day.
What's going on?
What's going on?
There's an echo in here.
There's an echo in here. Let's get the chart up here.
Okay.
And scarring is the result of
selling off here.
Infection in the lung.
Jesus. Just can't get these things to be quiet.
25.47. So the high today was around 26.40.
Okay, but look at that chart.
We're about 100 points off. Yeah, but
that's not a recovery.
No, that's just wallowing along the bottom.
Yeah.
Yesterday was the second worst percentage down of all time. So here we are, and this is the action today. Well.
Yeah, okay. So again, looking back at 2008, the financial crisis was characterized by days like this in between sharp drops and sharp increases. So basically today is a tread water day.
Tread water day, absolutely.
And it absolutely has zero indication one way or the other, either technically or fundamentally? Is that safe to say?
Yeah, you know what? There's no resumption of the downward trend. It's just, one of those things.
Yeah.
The gold stocks are getting hit here.
Well, they've been getting beat up for quite a
but
bit
they're,
now. Our erstwhile Galani Gold, who is our sponsor, has been knocked down by 40%. 10 cents to 10 cents to 6 cents a share. And this is a company producing that's going to have $38 million in free cash flow this year?
$9 million this year.
Oh, $9 million this year, right.
But producing, 60,000
ounces next year
of gold.
Yeah. No, that's just incredible. I mean, again, we're looking for a big bounce in gold to happen at some point here. Well, when gold started to really take off was when they announced those big, the big TARP package, because the interpretation was, wow, if the Fed's going to start printing money, that's good for gold. And that was what catalyzed the gold price. It's actually what also saw a huge jump in the amount of futures being traded in the gold side, and the obfuscation of who those traders were through the 2-week delay that is part and parcel of the Commitment of Traders report.
Sure.
That comes out every 2 weeks and then does a look back for the 2 weeks previous as to what the Commitment of Traders reports were in the futures markets. And that's just like, in this day and age, really? Can't we have intraday data on who's trading gold futures? No.
Yeah.
And when this one of the greatest frauds, I believe, that's perpetrated on the American and actually citizens everywhere is this idea that capital markets are in any way public. They're not public. They're hidden behind multiple layers of, data and anonymity.
You think of an onion when you think of layers.
Exactly. You could peel that sucker back and you still won't know who's behind the trade.
You can't get to the sweet spot.
So they shouldn't be called public markets at all. They should be called private casinos for the ultra wealthy and elite. Anyways, so Bruce Campbell is here. Let's have a chat with him. Bruce Campbell joins me now. He's portfolio manager at Castle Asset Management. Bruce, welcome back.
Yeah, thanks for having me back. It's been a few weeks.
Yeah, it's certainly interesting times we live in. Bruce, let's start the conversation with what's your take and expectation of the performance of the cannabis sector in the midst of this financial crisis?
Well, certainly it's going to be challenging. If you look at the fact that the banks and investments like that have gone risk off, you certainly wouldn't expect investors to be flooding into cannabis stocks just with the high risk nature of and the high volatility that they typically had. That is even more so when we see the markets at sort of historic extremes.
Mm-hmm. So then it's safe to say that despite the fact that pot stock prices are cheap, there's no reason to believe that they have reached a bottom at this point, is there?
No, I wouldn't necessarily say that. I mean, obviously we would probably need the overall market to have formed a bottom as well. But if it has, then that's where the opportunity will lie in cannabis, and it depends on your time frame.
Mm-hmm. Okay, so your firm is not solely interested or invested in cannabis. What other sectors do you participate in, and where do you see opportunities in this general climate?
I mean, we invest, across the spectrum. So, we'll look at really any sector. And I mean, we're as shocked as probably a lot of people with the extremes that you've seen from a selling standpoint and some of the opportunities that are created there. So, just as an example, we've been picking away at some of the banks here. We're really surprised at the yields that they have. And, if you can lock in these types of yields, that you're getting a Canadian bank that, the price is going to bounce around, but you're getting paid that dividend payment, which in the bank's case is, most of them are fairly secure. You don't have anything to worry about. Then you have capital appreciation upside. We've seen some technology sector areas that, stocks that have really been beaten up and dropped off. Obviously the oil and gas goes without saying how bad it's been. We haven't really stepped into oil and gas at this point in time, but it's at some point in time going to become this monster trade. When that is, I don't know. Probably we need to obviously have the the commodity market for oil and gas right-sized, both from a supply perspective, but also from a demand perspective. And right now, they're both going in the opposite directions. But when they changes, there's going to be huge opportunities. You could see stocks that probably double or triple, and not even be close to the levels that they started the beginning of this year.
Mm-hmm. So the banks are offering improved yields because they are trying to maintain the support that they see in the financial markets, or is there some other mechanism at work here?
No, it's a function of their dividend yield. So they've obviously kept their dividend yields where they are, and at the same time the stock price is sold off. So
I see. Relatively,
as an example, like Commerce is trading, with a over 7% yield. And many of the other banks are trading in the sixes. So, if you think about the fact that that's a dividend and you get a tax credit on that dividend, your after-tax cost is or your after-tax equivalent in interest is significantly higher than that yield. And then you think like, well, I can't even get on an interest basis a yield is that high. You do have some volatility still. It's not like buying, a GIC at the bank where that your principal is always going to be protected. But what is that the banks have been, very resilient as far as paying their dividends, even during the 2008 financial crisis. And that's not what this is. And, then the stock price can also appreciate over time. And they're also great dividend increasers as well. So they're always increasing their dividend, sort of year to year. That is huge advantage for anyone that's looking for income.
Sure. Do you think that the willingness to continue paying dividends at that rate will be impacted negatively should markets continue to demonstrate weakness?
Well, obviously that's a potential that you have to look out for. But if you go back to 2008, the banks didn't touch their dividends, and there was a lot more concern at that point in time about the global financial situation. This is completely different. This is really, a shorter term event. Do we know how long that is? No. And that's what the market's concerned about. Is this a 2 month? Is this a 2 year slowdown? We don't know how much and how deep it goes, but it's completely different than what we've seen in the past, where it was Fed induced. This is strictly just because of this coronavirus and the shutdown of the world to try to stop the virus. It's hurting economic activity. The banks will bounce back, and for the most part, their capital ratios are in line. There was a lot of people obviously looking at oil and gas this week with a lot of the oil and gas loans, but really for the most part, the Canadian banks are under 3% of their total loans are in oil and gas, and some of them are in the low ones. So it's not a big percentage of their loan book.
Mm-hmm. So I guess if Russia and Saudi Arabia were to settle their differences, we could expect to see a rebound in the oil sector easily.
Well, that's step one. And then obviously step two is on the demand side of things. Demand from a short-term perspective will have dropped off significantly. People aren't traveling. The factories have been shut down. All of that's going to have an impact. But that should be, a short-term event that demand probably, for the industrial capacity goes back fairly quickly. For the travel sector, it's going to be probably a slower ramp up as people feel comfortable that they can travel and they don't have to worry about, catching the virus.
Right. And by all indications, if we look at China's apex of rates of infection and the continuing decline in rates of infection and mortality, it looks to me like there is no reason to think that the coronavirus issues currently gripping the later stage countries that have been involved beyond summer.
Yeah, you sort of think that the numbers could, peak in the next probably, 4 to 6 weeks, and then at that point in time, they would start to have that decline. And so you're right. You're sort of looking at somewhere in the sort of the summer time frame. How long we stay, kind of without events and without, sort of the recommendation to travel. That's what we don't know. And that'll all depend on how fast this all gets shut down, right? If everyone sort of is most strict and adheres to all the rules, then it has no one to jump to and no one to spread to, and then once it's run its course on the people that have it, it doesn't get to anyone else.
Right. So then, it sounds to me like there's a hell of an opportunity coming up here, and that if you did not get completely wiped out in the meltdown that has occurred, it's good to be in cash and wait for the signal that the market's going to reverse. I mean, convergence of a few positives like the oil crisis being resolved, the coronavirus running its course, could easily catalyze a major reversal of fortune.
Yeah, especially with the stimulus that's going to come at this market. We're seeing monetary stimulus. We'll probably start to see some fiscal stimulus as well. And then even if you were an investor and you were in the market, and maybe you take a look and you start looking for opportunities. So let's assume that you had a diversified portfolio, but that maybe included an underweight position in something like the banks. Well, you could sell something else that's down and replace it with a bank, and you're going to high grade your portfolio. So there's always that opportunity, especially after you've seen really everything sold off as hard as it has.
Mm-hmm. So then, in terms of the degree of severity of this particular downturn relative to 2008, is it your opinion that this is more or less going to be much more just market related, whereas the 2008 crisis was very much economically driven as a result of the excess liquidity and the collapse of asset-backed securities and mortgages? Do you think this is just more like a technical glitch then caused by the coronavirus?
Well, certainly people are going to look back at this and talk about the coronavirus crash of 2020, and it's going to be related to 1929 and 1987 as far as what happened. From an economic standpoint, that's the thing the market's most concerned of, and of course, everyone who lived through 2008 knows how bad it can get. And so, they're doing the extrapolations and saying like it's going to get worse than we think. And, when it does, I don't want to own stocks. And so, they were just exiting. Obviously the opportunity is that, if this thing rebounds, when I say this thing, like the virus gets shut down or slowed down, or the other thing is, people sort of look at the severity of what it is to get the virus and how we can protect, the people who are most at risk. Then at that point in time, you could see that excess demand that's been taken out of the system come back in. Plus you have stimulus from an economic standpoint, from a market liquidity standpoint, that could really fuel this thing higher. And that, is that later in 2020 or is that out in 2021? That's what no one knows. But when it happens, it could be really significant.
You bet. All right, Bruce, we'll leave it there for now and come back to you next week. Thanks very much for joining me again today.
Okay, thanks a lot. Have a good weekend.
If you're enjoying the show, subscribe to Midas Letter on YouTube so you stay up to date on everything investment. He's relatively pleased and calm about everything. He sees it all as an opportunity.
Yeah, there's always an opportunity.
Always an opportunity. No matter where you look, opportunity is knocking.
We're in historic times. I mean, they're shutting down.
This is a time in history.
Yeah.
This is the times of our lives.
I guess every second of your life is going to be history.
Well, at some point. In fact, history is occurring at all times. Okay, so we've identified that the bank stocks are one place that you can put your money now. You're capturing the dividend despite the reduction in the price of bank stocks. That represents an opportunity. Some tech stocks are oversold. There is an opportunity. I think that the price of oil is an opportunity because the halving of the oil price as a result of the Saudi chopping its price in the initiation of the price war is temporary. And so look at the factors that negatively affecting oil. Consumption is down because travel is down. Airlines are not flying, therefore oil consumption is low. The price is cut in half because the Saudis are having a price war with Russia. And coronavirus is further undermining demand for fuels and gas because people just aren't moving.
You probably don't have to rush out though and buy today.
Well, but this is the thing. Just like the the price of oil halved overnight when Saudi Arabia announced that it was going to cut the price of oil.
Right.
Just as the oil stocks crashed that morning, so the reversal will occur upon the announcement, which will probably not happen during trading hours, that a deal has been reached between Russia and Saudi Arabia and the price is going back to $50, $60 a barrel.
Right.
So you don't have to rush, but you certainly don't want to wait too long.
Is that a little short for Russia? You don't have to rush?
Rush into Russia. No, but the point being that
Right.
he who hesitates is lost.
Yeah, they may want to keep this thing down here to hurt the frackers.
Hurt the frackers? Those mother frackers? Polly want a fracker? Yeah, the frackers. Well, the frackers, though, recall 2012, the U.S. kept prices low to try to hurt Russia, and the frackers suffered. Nobody cared because the frackers weren't the old money. The frackers were the upstart new money in the in the patch.
Right.
And they went away and adapted and came back just as soon as the price of oil went up. So, you know, the fracking industry is not something you can wipe out per se just by having low prices for a while, because it'll come back just as soon as prices dictate. And with oil being produced at a maximum rate, like the minister of Saudi Arabia, the oil minister, requested that Saudi Aramco increase production to 13 million barrels a day from 12 million barrels a day, and they're maxing it out at 12.5 million barrels a day. I mean, so right now, Saudi Arabia, whose 95% of their GDP is based on oil production, is using up the maximum rate of their oil to sell at half price what they normally do. Now, in the Saudi Arabia versus Russia context, then maybe it's in Russia's interest to keep that game going for a long time, sure. But really, do we really know what Saudi Arabia's reserves are? Like, how long can they afford to continue to sell oil at half price before they actually take a serious hit on their reserves? Those are questions for me. I'm looking forward to that.
There's lots of questions. There's not a lot of answers.
Lance Ippolito joins us from Wealth Press's Future of Wealth Now. Lance Ippolito joins me now. He's the publisher of The Future of Wealth on the Wealth Press Network. Lance, welcome back.
Hey, James. Good to be here.
You bet. Lance, what are you seeing down in Florida, Tampa, that is evidence of the reaction to the coronavirus and the market collapse?
Yeah. Wow. As we were just talking, it's really hitting Florida hard. And you have to realize, too, Florida, we have such a elderly population where it seems to be the coronavirus is most dangerous. Like, to give you an example, World Wrestling Entertainment, WWE, they have their WrestleMania here in, I think, 20 days. It's 100,000 plus people from all over the world, and it brings in massive revenue for the city. And they're thinking about canceling that, which is about a week-long event. So they're trying everything they can here in Tampa to keep the economy booming, but people aren't leaving the house. Kenny Chesney canceled his concert at Raymond James Stadium, which fits about 70,000 people. And the global markets, not just the U.S. markets, especially when you look at European markets, they're taking a massive hit on the chin. We were down 10% in the indexes here in the U.S. yesterday. Overseas, some names, especially the DAX, were even down more. And then today, specifically this morning, and the overnight session in the futures market, we had about a 1,500 point rally in the Dow futures off the lows, and we actually got halted because the futures were limit up, and the indexes, which do not get halted, like the SPY, they were up about 6%. Well, since the market opened, they've been fading. Airliners, which were up 10 to 15%, now they're basically flat. And the Russell 2000, which measures small caps, or you can look at the IWM ETF, it just went red, literally within the last 10 minutes from being up about 6%. So stocks are selling off. The S&P's now only up 1%. We're over 100 handles off the high. Nobody wants to be long going into the weekend. This is interesting times. It is very volatile in the markets. If you're a trader, if you're an investor, you really have to be patient and selective because of all the unknowns out there.
Yeah. Yeah. So I guess the opportunities in terms of what's happening is at some point you can be short in and out of the market if you are have that kind of risk tolerance and expertise. But for the most part, it looks like large, long pools are pulling out their money now and under the conviction that they'll be able to buy back whatever they sell today a lot cheaper down the road. And as long as that sort of mentality prevails, and again, as long as the Fed's efforts to inject capital, $1.5 trillion yesterday, arguably as much as $4.5 trillion in the last week, fail, there's no reason to believe that there's going to be an end anytime soon, is there?
So, James, you make a fantastic point. We rallied about 1,000 plus Dow points on that injection of liquidity into the markets, and within an hour we gave back all of it. And within a couple hours in the afternoon, we actually closed on the dead lows. So the market's not buying what the Fed is doing. In my opinion, not to get into a whole Fed and political speech out there, the Fed is out of ammo. And that's what we're seeing. They could cut rates, they could inject liquidity, but the fact is they're running out of ammo, they're running out of tools to help save the market. And when you do have, Kudlow was the first one to come out, advisor to the president. You had Eric Trump, you had the president, you've had Kramer, and now you've had Steve, I call him the Munchkin Man, head of the Treasury. He even came on the television this morning, 9 a.m. Eastern time, and said, right now is a fantastic time to buy stocks. We'll do whatever it takes to stabilize the markets. It's not helping. Right. It's very fishy out there. And what I was telling people earlier today, you just don't go fishing, take a shower, and you don't smell like fish anymore. When you're surrounded by fish and you're touching fish, you're going to smell pretty fishy for a couple days after. And that's what this market seems. It's not buying really any of the Fed political heads out there. It's not buying what they're saying. It's in its own world.
Sure. Do you think that, would you think it's safe to say that the only recourse for central banks globally is direct asset purchases in stock markets? Instead of printing cash and injecting it into money markets, why not just start buying stocks, and at least that transmits a direct floor to the market?
So that's what's been getting thrown around. And it makes a valid point, putting in a floor, but what happens if the Fed starts buying stocks and stocks keep moving lower and lower? And you start having what we haven't seen, and what is the unknown is, what are companies going to do 2 to 3 months down the road? What is the effect of this coronavirus or of the economic impact from it? Will you start seeing companies cut dividends, lower earnings? Well, we've actually already seen that. Are they underestimating the impact of the coronavirus? There's so much unknown out there that, individuals can even say, well, stocks are cheap. But I go back to them, I say, well, what is cheap? Was Disney cheap at 130? Was it cheap at 115? Now it's at 92. It was just at 150. So what is cheap when you start looking at stock prices? And that is the big question out there. You could go and run, and the Fed could go and run and buy stocks, but if these stocks and if the market keeps going down, what happens? Sure. What happens if the Fed loses control and there's nothing else to do? There's a lot of question marks out there. So I really just, for the audience point of view, is be selective, be patient, and really don't go and put all your eggs in one basket. Just because you heard someone say this or this out there. Right.
So are you a buyer today?
So I'll give you a real life, and I'll be 100% transparent example. Last week I wanted to buy airliners. I wanted to buy JetBlue. I wanted to buy Delta. Warren Buffett's been selling puts. Warren Buffett added his stake to Delta. We all know Warren Buffett, great investor, lots of capital out there to put to work. Well, when I wanted to buy JetBlue, it was 15 a share. Now I think it's 12 a share. When I wanted to buy Delta, it was around 50 a share. Now it's 35 a share. So I'm not. I'm trying to be very, very selective. And eventually I do want to start scaling into positions. And what I mean scaling in is, let's say you have X amount of dollars. You don't go and put 100% in that stock. You maybe scale in 10%, then 10%, then 10%, then 20%, divide it out over a series of time.
Yeah.
But I'm not. And, maybe when we take out the lows and when we start to flush and I stop getting texts and phone calls of, hey, what are some good stocks to buy? When there's so much panic and fear out there where people are just throwing up or they can't take holding stocks anymore, that's when I really want to be a buyer. I think that's soon, but there's still a lot of uncertainties. Like I just don't feel comfortable and confident just throwing darts at stocks right now, hoping the next 2 weeks go well.
Right. So if you have to sort of look out there and pick a level, I mean, where do you think the stock market? I mean, it's just as it has a breaking point on the upside, it has to have a place where it says, this is as low as I can go because there's nothing left to sell here. Like at least in terms of, capital pools that have been buying U.S. stocks and are now selling U.S. stocks. Most of those large capital pools, nothing's 100% stocks generally. And if they are 100% stocks, I got to think that they're nearing a 100% cash position at this point. So, as we, go lower and lower in the Dow and the S&P, I got to think that there's a number out there where the Dow starts to sort of draw a line in the sand, so to speak, and investors sort of like it's just going to stay there for a bit, and then investors are going to start to wander back in. Would you happen to have a number that you would want to throw a dart at in that regard?
So you make a great point, and I like that line in the sand example. So in the Dow, remember back in December of 2018, right around the holiday season, we had that low volume major sell-off. The Dow dropped about 4,000 points within a couple weeks. That was around 21,700, give or take about 10 to 20 points. We actually took that out yesterday. We're trading around 21,300 in the Dow. So we actually took out that previous low, which is, in my opinion, very, very scary in the Dow. So I think when you look at the Dow, it's 20,000. That was 2017 levels. And in the S&P, we still haven't reached. It was right around 2,400 back in December of 2018, and we're right around 2,500 right now. So I think we still have about 100, possibly 120 points in the S&P lower to go. But what's really caught my attention is the Russell 2000 or small caps. Now, these names are very sensitive to China, making up a lot of financials, regional banks, and energy stocks. And the Russell 2000, it took out that December low earlier in the week. That was around 125. We're at 109 now. And we're trading back in the Russell where we were in 2016. So think about that. That is years of gains wiped out in a matter of weeks. That causes a lot of pain when you look at mutual funds, when you look at hedge funds who weren't hedged, so to speak, or weren't hedged enough. That's a lot of pressure, right? That's being underwater for a long period of time where I just don't see how we have that V bounce back that we normally had on corrections and sell-offs, because in my opinion, it's not tech related. And every time we've had a sell-off in equities in the past, it's because of tech stocks or tech valuations. And in this case, tech stocks are actually holding up very, very well.
Yeah. Okay, let's leave it there for now. Looks like it's more or less a wait and see kind of environment out there. And we'll come back to you next week and see what happens on the other side of darkness. We'll talk to you then. Thanks for joining me.
Thank you, James. I appreciate it.
If you're enjoying the show, subscribe to Midas Letter on YouTube so you stay up to date on everything investment. Yeah, not only subscribe to the show, but hit that little bell button in the top right of your screen if you're watching on YouTube, or otherwise subscribe to our newsletter at MidasLetter.com. That takes us to the end of our first week of the Financial Crisis 2020 coverage. We wish you all the very best in health and security and safety, and hopefully we'll see you all on Monday. Thanks for joining us.
Join your line, Tootsie.